Welcome to the AWA Market Minute, breaking down financial, political, and economic events that impact today's retirees. Our investment committee performs hours of research and market analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring top industry experts who share insights on important topics so that our clients can gain understanding and peace of mind on their journey to and through retirement. And now your hosts, Chief Investment Officer Scott Hoxer and Founder and CEO Paul Coles.
Well, welcome everyone to this month's edition of our AWA Market Minute. This week is a big week for the earnings reports. We have 181 companies that will be reporting earnings this week. But of note, 5 of the 7 Magnificent 7 stocks will be reporting earnings. Starting today with Alphabet. Tomorrow we've got Microsoft and Meta. And then on Thursday, we'll have Apple and Amazon rounding out the 5 of the Magnificent 7. Interestingly, these 5 account for almost 25% of the S&P 500, which is, obviously a pretty big volume. And between that, Friday's jobs report, and the approaching election, we're watching very closely how the stock market is playing out this week.
For this month's market update, markets continue to do extremely well. As you can see here, the NASDAQ up almost 25% so far this year. The S&P continues to do well, as does the Dow. We have a couple new entrants here on our update. Tesla's an interesting one. It's only up about 8% this week, but on the back of really positive news from Elon Musk, it's up about 25% in the past 5 days. You can also see Bitcoin and almost all risk assets continue to rally and continue to do well. For our roundtable discussion today, we are super excited with our guest panelist today. Kurt Brown, who's joined us before, is going to be our guest panelist, and he'll have a thorough market update. Kurt is a industry expert and fan favorite. And Kurt, great to have you with us.
We're super excited, Kurt, to have you join us today.
Gentlemen, it is always good to be with you guys. It's been a minute, and thanks for inviting me back. So we're going to go through a couple things here that I think might be relevant for everybody, and regardless of what your portfolio looks like. And for some of us, our portfolios are very, very conservative. And for some of us, they're a lot more aggressive or something in the middle. So let's summarize a couple things that have been happening this year. Most people did not have on the radar this year this type of return in stocks. And you can see it on the screen there, up, 21, 22, 23% roughly on the year. Now, again, that totally depends on your portfolio, right? Everybody's got portfolios that are built differently. Some are much more conservative. So this is just generally if you have a basket of S&P 500 stocks. But even bonds spent a lot of the early year down. They've gone higher. Interest rates have moved back lower. A lot of you know that. We'll talk about that in a second as it relates to real estate. We had a problem early in the year where the market was being led predominantly by a small group of stocks. A lot of those big cap tech stocks were leading out. Most of us know that. You can see that on the screen here. But as the year has gone on, it's actually gotten better. There are more stocks and more equity investments total, not just stocks, but other types of asset classes that have participated more in this rally as the year has gone on. So that's a big deal. And that is a sign of a healthy investment market typically, right? And we know there's a lot of really interesting themes taking place right now. If you look on the left, you can see on the top left there, this is what earnings have done in terms of earnings growth year over year. So the last couple of quarters, you're talking about some of the biggest businesses in the world growing their earnings at over 10%. And that's an average. Some of them are doing 20, 30% growth, right? And then if you look at the bottom on the left, that's GDP. So is it blistering? No. Is it back to the heyday of growth in the United States? No. But it's still, if you're running a 3% kind of growth rate and you have interest rates coming down and you have earnings at 10% growth year over year, you don't have a lot to complain about, right?
I feel like that's the antithesis. That's the whole goal of when they talk about the soft landing, right? Able to
Yes.
bring GDP, safely flatlining to north while lowering interest rates, and we all kind of held our breath, and it appears like we're going to get there.
And it's really funny because so I've been in the business a little over 30 years, 31 years. And what's so fascinating is that you can, if I had to pick one indicator, the more negative the investment community is, the more I actually want to be buying assets. If you just made me point to one thing. And what's so interesting is how negative everybody is because of what you just pointed out, Paul. You can see some more earnings estimates on the right going into 2024, and then on the left, and then on the right, you can actually see what yields have been doing. So we remember in the middle of 2023, mortgages got themselves up into the 6.5, even 7% area. That's come down a lot. And that is really the ideal backdrop. You've kind of got this softening interest rates. We'll talk about inflation in a minute. It's really come down a lot. You've got earnings going up. You hate to say it. Nobody wants to say this. Nobody wants to be Pollyanna, but the environment has actually just been really, really good. So as you know, the Fed finally started easing up on interest rates a little bit. And so you can see, we're looking at a little bit of history here. On the left, what Fed funds did. So we took interest rates during COVID down to zero. And then the Fed wanted on this tightening campaign through all of 22 and early 23. Then they paused to see how that was going to play out, right? And it worked. It's funny because the Fed takes a lot of heat, but as bad as the experiment during COVID was, and there's a lot of postmortem on how stupid the COVID period was for a lot of reasons, but coming out of that, the Fed's actually done a pretty good job, and you can see inflation here. And that's what that chart is showing, sort of two different forms of measuring inflation, PPI and CPI. And you can see the takeaway is they have both come down into that long run average of around 2 to 3%, which is exactly what the Fed is trying to do. You actually don't want zero inflation. That is typically the sign of not a very good economy. This basically says, this is a busy slide, but all this is saying is that through a lot of last year, there was a lot of indicators saying we were going into a recession. We just have not seen it. And we could debate all day why, but at the end of the day, we've been dealing with something we had never experienced before. Remember, we put $5 trillion in different types of cash instruments into the economy during COVID. It is something we had never dealt with before. So we're trying to sort of sop up all that extra liquidity, and we'd never had an experiment like this. And so a lot of indicators were pointing to a recession. The Fed raised rates to slow things down and has now come off and lowered rates again to try to make sure the economy stays in a really good spot. Now, as of this moment, it's totally working, right? So you can see on the screen here, we saw last month the Fed cut 0.5 point. That's a fairly big cut. Chairman Powell wants to indicate to the market, listen, we're serious about this. We are not going to let the economy slow too much. But remember, we've talked about this a lot over the last couple of years. We really needed to control inflation. Inflation is one of the most dangerous things you can have in an economy. So we had to get that under control. It appears that we have done a very good job of that. And now the Fed is slowly lowering rates again.
Hey, Kurt, really quick on that point, because I think it's an important one. And to your point, Fed funds futures show that we're going to see an extended period of rate cuts, which typically is a good tailwind for the economy. One interesting thing we've observed over the last couple of weeks, though, is the 10-year Treasury rate has tended to drift up a little bit. Today is knocking on the door of 4.3%. So almost, and decoupling is too strong, but there is some of that that's occurring where Fed funds futures are suggesting rate cuts, but the 10-year Treasury is drifting upward. Is there any concern that market participants feel that kind of the overall level of rates needs to be higher based on a number of economic factors than maybe what the Fed wants to see?
Yeah, nobody's going to like my answer to this question. What guys I talk to in bond land are basically sniffing out a Trump victory. And 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 the market is actually building that in. What you're seeing in financial markets is the pricing in of a Trump win. And so what that means is different than what a Harris win would look like, right? So the market is sort of anticipating an acceleration of the economy. And there might even be a little bit of nervousness about inflation ramping up again. Because remember, we all are a little bit nervous because we saw that insane inflation for 3 or 4 or 5 quarters in a row coming out of COVID. It's not going to happen. There's a little bit of worry of that, Scott, and that's why you're seeing the 10-year trade like this. But it's a different time. We're in a different place, and we know how this goes. What presidential elections show is a ton of talk, but what you can get done in Congress, that's a completely different animal, right? Yeah, it's a great point, Scott. So we anticipate rates coming down, but I will say the bond market doesn't always get this right. For 2 years, the bond market was pricing in rate cuts that they didn't get. And by the way, I like that because although we don't want higher rates, what I do want is a Federal Reserve that is not going to let inflation get out of control, and they're just not. And that gave the market a lot more confidence in Chairman Powell that, frankly, we kind of didn't have in him as we were going into COVID, right? So I'm going to skip a couple of these here. This is really interesting. I kind of want to show you under the hood what some of the most critical data is around how healthy are we actually, okay? So if you look on the left, this is delinquency rates on consumer loans. Now, we are seeing some creep up in that. Now, what's important is you're just a little bit higher than what the long run average had been. The COVID period, remember, was remarkably low. We were just dumping cash on people to stay home. So nobody was defaulting or delinquent on anything, credit cards, et cetera, et cetera. But the other thing we're seeing on the right is we're seeing job openings slowly come in. So I actually think this is not a reason to worry because remember, we had a labor market that was incredibly broken coming out of COVID. There were actually too many people sitting at home on their couch. We needed more people back into the labor market. And if you look at before COVID, we're getting back down to something more normal. So I'm still in the camp of normalization is taking place, not that the economy is rolling over. Is it slowing? We know that it slowed a little bit. We've known that we've seen, an uptick in delinquencies and payments, more people using credit cards to live off, et cetera. But remember, when we say more, we're only talking relative to the ridiculousness of 2021. If you look at these longer run charts, you're actually just getting back to where we were before COVID, if that makes sense.
Yeah.
Again, we've kind of already touched on that a little bit. I want to highlight this. This is really important. A lot of people are hand-wringing about investments in general, whether it's stock market or private equity or any type of risk type of investment that you can make. There's a lot of hand-wringing right now, partially just because markets have gone up for 2 straight years. But what's important to understand is that chart on the left. This is just simply the 500 biggest companies in the United States and how much money they are making. And there's not really a lot of ways to mess with this data. This is just straight earnings reported. And look at that growth. I mean, you're going from $225 a share to nearly $270 a share in less than 2 years. It's just torrid growth. I mean, there's no way to even argue with this. So when you look at a market that's up 22%, you're talking about earnings that are up just as much. So it's kind of hard to debate that, right? And if you look at the right, you look at what has happened in these periods, like the dot-com blow up 20 plus years ago, the great financial crisis where earnings just got hammered. So we do go through these periods where earnings really do get obliterated. We saw it in COVID, but it didn't end up being as bad in COVID. And so we got this little dip last year in earnings and everybody thought recession, recession, recession. Do you remember when everybody was yelling about that? We only ended up having for the year a 2% drop in earnings. That's it. So, I mean, think about what the market has had to face and has had to deal with in terms of labor market disruption. Interest rates went from 0 to 5 in 1 year. Like that was a very aggressive rate tightening pace. And it hasn't even mattered to earnings, right? Earnings have continued to go north.
Real quick on that, Kurt.
Yeah.
In terms of attribution, what has driven that earnings growth? Is it, Is it cost cutting? Is it, productivity gains through things like AI? What's been kind of the, driving force with some of that significant earnings growth? Because it has been anomalous.
That's an excellent question. And I don't have the chart today, but I have this great chart that shows the number of employees required to generate $1 million in sales. And what do you think that chart looks like over the past 20 years? It's gone from 8 employees to 1.
Yeah.
So to generate $1 million in revenue. So we are still getting a tremendous amount of efficiency from technology. That is a massive part of what we're dealing with. And the second part of it is the consumer has been better than anybody has wanted to give them credit for. And you know why, Scott? Because since the financial crisis, consumers have been so scared of having debt that they have kept themselves clean. And they were able to weather COVID and even job loss better in this cycle because they were not burdened with a lot of unnecessary debt. And those two things are the largest contributors to you seeing earnings doing what they're doing. Yeah, it's an excellent question. Some of my favorite data, there continues on the left there to be a tremendous amount of cash on the sidelines. I'm only showing you corporate. I can show you chart after chart. Households, corporations, I mean, you name the group, fund managers, private equity fund managers are sitting on record amounts of cash. Fund managers of almost every asset class are sitting on record cash. S&P 500 companies, Fortune 500 companies, small businesses, even mom and pop in their household are all sitting at near record amounts of cash. The only group that's excluded from that is the lower 1/3 wage earners in this country. That group is the group that's been hurting more. With costs going up, that group is the one that has struggled the most. But almost every other group or category you look at is holding an insane amount of cash. And it's very difficult to have an economy roll over into a bad recession when you have a lot of liquidity sitting around, because you're taking the panic out of the system, because people can weather these types of events more. Household net worth, that's a little bit of a cheat on the right. Most of household net worth is around 2 things: your investments and your house. That's the vast majority of household net worth. But look at that. It's not a double in 6 years, but it's pretty close. Housing prices, even with everything that's happened. Remember, mortgages went from 3 to 7, and look what housing prices did. They went down a tick and then just stabilized. And so most likely what we're dealing with is a multi-year sideways movement of real estate so that rents can catch up, wages can catch up, but you're probably not looking at any kind of real trauma in the real estate market, because remember, we were way underbuilt. The problem coming out of COVID was we just didn't have enough houses. So you're getting a real estate market that's sort of normalizing. The thing on the right there is really healthy, because that's the number of refinancings in the United States. So when interest rates went way up, of course, refis went to nothing. And now that rates have kind of come back down, we're starting to see people refi again. The reason this is really important is it allows Americans to sell one house and buy another house. So as interest rates come back down, you will allow people to begin to move around, which actually also makes a healthier labor market, because now I can sell my house in Topeka and move out to Salt Lake City and buy a house, right? Which people kind of felt trapped last year because mortgage rates were so high.
It's almost, Kurt, like there's a velocity of housing movement metric, right? Like they have with the M2 money supply. It'd almost be good to have like a housing metric. I'm sure there is one, but you're saying, hey, now that market has more movement or more velocity in it than what it historically has had, or at least over the last couple of years.
Yeah, and we really need that, because that, Scott, acts as a clearing mechanism for the real estate market. So even all the new houses that got built last year when the market slowed down, now if mortgage rates come back down, we can start moving through that new inventory. It actually gives us a much more healthy dynamic. And that's why you're seeing this big uptick in refinancings. Now, disposable income. Okay, we all know things got really expensive at the grocery store, okay, especially coming out of COVID. And there's no way around it. That's a problem. But what the hand-wringing social media fear community is not going to tell you is that compensation, wages in this country, that's the black line, and disposable income, what you have left after your core expenses, has gone up faster than inflation. This chart you're looking at is indexed to the day COVID blew up. You remember this in February 2020. So from that moment, the black and the green is above the yellow, and the yellow is inflation. So the average American is actually stayed ahead of inflation relatively nicely. Nobody wants to talk about it, but that's the facts. It is shocking to go to the grocery store and see a block of cheese cost $12. Like, I agree, it's shocking, but the reality is Americans are making a lot more money. And anybody that owns a business knows this. Like, think about what it costs to hire good people. You guys know you run a great practice, and it's to get quality people, you got to pay a lot more. This is really interesting. The hours of work necessary to afford a week's worth of groceries, look how much that's come down. I was talking to my grandmother not that long ago, and she was telling me that, back in the 50s and 60s, what percentage of their household income that they had to use just to spend on groceries. And going out to eat dinner was just only for the rich. I mean, the most rich, and so it's really interesting. Sometimes we forget historically where we are sitting, so
it is an interesting point. Side note though, disposable income has outpaced inflation, wages have outpaced inflation.
Yeah.
The impact of this for retirees might feel a little different, right?
Yes.
Where their wages may not be pegged to any kind of inflationary adjustment. Some have fixed pensions. Social Security may or may not keep up with the inflation rates. And so that does maybe add a little bit of a wrinkle to the retiree pool, where it says the need for appropriate investment models becomes even more critical to ensure that you are also outpacing the inflation problems.
Paul, that is brilliantly said. And remember, I said earlier in the conversation that inflation was one of the most dangerous things that could happen to an economy. And this is why. Inflation is what you just said so eloquently. It's toxic, and it really hurts your pensioners. And it's one of the reasons you got to remember, when people start talking about inflation, what do we always hear about in terms of the investment side? We always hear, well, you got to own gold or crypto or like whatever you got to own. Historically, stocks have actually been one of the very best inflation hedges in the world. And I mean, for like 200 years, because what happens in inflationary periods is companies make more money. And so it's one of the reasons that even in our most conservative portfolios, we like to have a little bit of growth in there, right? Like, as financial advisors, we like to just, if you can even have a little bit, because that'll kind of help you hedge if inflation gets out of control. I'm glad you brought that up, Paul.
Yeah.
Really good point. Personal bankruptcies. This is typically, you're going to see some real trauma here. Look at what it was like going into 2000. Okay, remember the .com blow up over here on the left side of the screen? Personal bankruptcies per 1,000 people. I mean, look at where we were, and then look at what happened in the financial crisis. Same thing. We got back up to about 14 out of 1,000 people. Look at this. Okay, we have come off a little bit off the lows. This is what I was talking about earlier. The average American is in better condition than you might think. Again, the lower 1/3 of wage earners have definitely felt more of a pinch in the last 2 or 3 years. But credit spreads, I don't want to talk about this too much, but the chart on the right is something that more savvy investors will really keep an eye on. You've never had any kind of major recession in this country without junk bonds getting murdered in advance. You will typically see the stress in the weakest companies first before the rest of the country feels it. So keep this in mind. And this is why you always want to keep one eye on junk bonds, even if you don't own any, because they typically will flash a warning sign. And remember in 22, what happened? The Fed was raising rates like crazy, and we started seeing a creeping up of spreads in junk bonds. So it's something you want to kind of keep your eye on. All right, I'm going to skip over that. I don't want to spend too much time on that. Okay, let's talk geopolitics for 1 minute. Everything you can imagine, from Taiwan, Iran, Korea, you name it. Now we've got Israel. We've got geopolitical all over the place. Now, every time I say this, I sound callous. These are genuine humanitarian issues, and they're important to us. But historically, these things have never really mattered to the United States economy and the U.S. investment market. And in fact, in many cases, it helps us. When there is fear around the world, people come to the treasury and they come to the dollar. And it's important that we have to say it. We have to divide those two things out. So it's scary watching the nightly news, but it's probably not a major risk to your portfolio. Let me show you something here. There's another example this year. Remember when Hamas attacked Israel? We all kind of freaked out for a minute, right? We were worried about Iran. We were worried about oil, getting things in and out of the Middle East, World War III emerging from the Middle East. And look what's happened. Whether it's stocks or oil, there was like 5 days of fear, and then things normalize. We get back to normal business. And it's complicated, the reasons why, but the reality is many times this is a blessing for our economy. And so be really careful letting the tail wag the investment dog. I have had people, Paul and Scott, my whole career, 31 years, I have had every year people telling me about China and Taiwan. Every year for 31 years. Can you imagine if you built your investment portfolio around that fear? Now, is it a legitimate fear? Yeah. But you cannot build an investment portfolio that goes around that. And so it's just really important. We've got to keep that in check. Now, all that being said, you guys, I know, because I've worked with you on a lot of client portfolios, do an amazing job of building something that prepares for that rainy day. And there are going to be times that you get a 9/11 or you get a COVID or you get something like that. And you've got to have a portfolio prepared for that. But none of us, we've all got to be careful giving too much credence to these geopolitical events. Okay. Polls, right? This is going to be wild, right? But this is another one of those things. Trump's definitely polling ahead, but as we all know now, the battleground states are where it is at. And if you look, you look at betting markets in the last month especially are really sniffing out a Trump victory. But again, we've seen this in the past. There's going to be 5 or 6 states ultimately that dictate that. But this is the point for this call and this conversation, is that there is absolutely no correlation historically for how investment markets perform with who is in the White House, the Senate, or the judicial. None. There are periods that we can point to. You can see it on the screen here where the Republicans are in control and the market did terrible. But sometimes the Republicans are in control. The market does amazing. This is another one of those things we just cannot let the tail wag the dog. Now, is it important to us? Oh my gosh. I mean, I don't know about you guys. I watch these issues. I'm stressed out of my mind because it's highly important to me, some of the stuff we're talking about. But again, when you're talking about in the investment community, it's zeros and ones. It's a non-emotional community. It is about return on investment and it is about risk-adjusted return. And we've got to keep the conversation to that. So, Paul and Scott, I don't know if you want to add anything to that or not, but.
Yeah, we looked at this in detail, Kurt, in our last market minute, and you're absolutely right. I mean, you can point to periods of time where there's a Democratic president and markets just go gangbusters, and a Republican, same thing. What we did find that was interesting, and your slide showed this as well, the composition of Congress and how that syncs up with the presidency does have an impact, right? If there's a Democratic president and a Democratic Congress, markets perhaps haven't done quite as well historically. And then the worst scenario you have here, and we showed this as well, if there's a Republican president and then full Democratic control of Congress, that's not an ideal outcome as well. So people should have an eye on the composition of Congress as well as they think about these issues.
Yeah. The funny thing is this, historically, I have this other chart that actually kind of shows the best periods are when there's total gridlock. And you know why? Because in the investment community kind of knows DC is a dumpster fire. So like if there's gridlock and nothing can change, we can just go about our business on the investment side. And investors really like that.
Yeah. So, they like to be able to predict what's going to happen next. And
that's right.
If nothing changes, it's easy to forecast.
That's right. Here's a great chart that shows the average presidential election year. And you can see where we are. We're in late October, where it's actually pretty normal. Right before the election, everybody gets nervous. But election years actually have a tendency to be pretty good overall. There's hand wringing kind of throughout the year, but we're getting to the point where we're going to start having some visibility real soon. And again, I think the market's kind of sniffing out a Trump victory. Now, if we have a Harris victory, you're probably going to have some adjustment in the market because different themes probably work going forward. Just a couple more slides here, and then I'm done. But one of the things that I hear on a regular basis, and by the way, this is totally human nature. There is nothing wrong. Even professionals feel this way. But when the markets run a long ways, we have a tendency to feel like, well, maybe I should sit this one out for a while because the market feels tired. It's come a long ways. Like right now, 10 out of the last 11 months, the S&P 500 has been up. And by the way, we can show this for all sorts of different markets, commodity markets and bond markets and things like this too. But what's really interesting is historically, that's actually been a great time to invest. And why is that? Because when that's happening, you're in what we call a bull market, which I kind of don't even like that term. It's kind of ridiculous. But what you're really talking about is a period of time where both the economy and the investment markets are expanding. And remember what I showed you with earnings. So interest rates are coming back down. We haven't seen stress in homeowners. We have earnings growing rapidly. So you would actually expect that the markets would also expand during that period of time. I have another chart I didn't bring today, but a lot of people have said to me over the years, well, the market just made a new high. I think I'll wait. Did you know? And I should have brought this chart with me today, but I've got this great table that shows if you only ever invested money on the day that the S&P 500 makes a new all-time high, you actually have incredible rates of return. We always think about you should buy the dip, which of course that's great. But it's actually funny because when the market's making new all-time highs, you're actually in very expansionary periods in the economy. And that has a tendency to go for a long ways. The average bull market goes, 2 to 5 years. And so we could actually be fairly early in this expansive phase. And I know that blows people's minds, especially these days when there's so much negativity and it feels like we should be really worried about everything that happens because, hey, let's face it, if I get on Twitter, it looks like the world's ending every minute of the day, right?
Yep.
One last thing I want to point out, and this is up for you guys to do. Every client is completely different, but I wanted to point it out, okay? We're gone through a period where a handful of stocks, 7 to 10 or 15 stocks are so massive in the weighting of the S&P 500 that we have a stock market that's kind of top weighted, okay? If you've been that way for the past 2 years, that's been pretty good for you. But historically, when that happens, you want to adjust your portfolio and get a little bit more of an equal weighting. So the only reason I'm bringing this is just be careful that your portfolio in your retirement plan is not too much NVIDIA, Microsoft, Tesla, Google, etc. Those 7 or 8 darlings. Just be careful because historically they will stall for a while and the rest of the broader market will sort of catch up. And that's all this crazy busy chart is basically showing you there. But it's something to keep in mind. And then here's sort of our checklist. Well, let's not go through all these. We just went through them, but there's lots and lots to like. There's a few things we don't like. Growth here slowing down a little bit overall. GDP not quite where we'd love to see it. But by and large, you give the landscape of what we've been through and the experiment we've run coming through COVID and out of COVID. Man, I'll tell you what, had you asked me 4 years ago, would we be this clean going into the presidential election in 24? I would have been skeptical. So all things considered, this is why markets have continued to act so well. So anyways, I'm happy to talk about anything else you guys want to talk about, but those are some of my prepared comments.
Kurt, that was awesome. We really appreciate you taking the time to jump on with our clients today and walk us through this economic update. I think everybody always values your insights.
It's super fun to be with you guys. I miss seeing you guys in person. We got to do this in person sometime.
Absolutely. Thanks, Kurt.
Thanks, Kurt.
All right, you guys. Take care.
Well, this month we had one of our clients ask this question. The Tax Cuts and Jobs Act will expire in 2025. What might be some of the effects on investors if this act is not renewed?
Paul, I think this is a great question. And I think as we talk about this, there's two different aspects to consider. As far as taxpayers are concerned, there are very material aspects and impacts of this expiring. Things like estate planning considerations, people itemizing instead of taking the standard deduction. All those types of things will weigh heavily on taxpayers. As far as how this will impact your investments, the answer is probably fairly minimally. Theoretically, the more money that's in consumers' pockets, the more of that flows into companies and pushes up earnings. And so on the margins, it maybe hurts stocks a little bit with the expiration of that, but very minor and very on the margins. Conversely, in terms of your tax and estate planning, pretty significant impact.
It'll be interesting to see, if there is any kind of a flee from growth to dividends, and then if there will be people that will start trying to unpack some of these unrealized long-term capital gains, if that'll have any impact at all. But we'll watch it closely.
Yep.
Well, rounding out today's episode, we'll give a planning tip, and that is this season, right at the end of the year, is when we tend to see the majority of our clients reaching out because they're getting required minimum distributions that kind of come through sometime in Q4. It's pretty common to get those. And we wanted to just highlight that many people who are receiving their required minimum distribution can take advantage of what's called a qualified charitable distribution, which is when they donate that RMD directly to their charity of choice, bypassing the IRS altogether. And this is beneficial for many reasons. One, many people already have plans to donate to charity, and so this gives them an opportunity to make that donation, which they were already planning on doing, oftentimes with post-tax dollars. This way they can make that donation with pre-tax dollars, and they don't have to, pay any of that income tax on the RMD. The other thing that we need to keep in mind is that has a significant benefit on your adjusted gross income when you're not recognizing that income tax in the year that RMD is coming to you. So that has flow-through impacts, things like reducing your provisional income, so potentially impacting your Social Security taxes, as well as Medicare Part B premiums, potentially reducing any of the increase on those premiums as well. A number of things that could be beneficial. And last point here is many people wait until the RMD is due, and if you were born after 1960, post the Secure Act being enacted, you don't have an RMD due until 75. But Congress did allow for QCDs to continue to work post age 70 and a half. So if you turn 70 and a half this calendar year, 2024, you still are eligible for a qualified charitable distribution this calendar year. You don't have to wait until your RMD is officially forced upon you. You can begin the QCD process. So reach out to your team here at Alliance Wealth Advisors, and we'll walk you through the specifics and how it applies, to your unique situation.
Yeah, I would say, Paul, if you're already 70 and a half and are making charitable distributions, let's have that conversation because there's potentially some savings there.
Absolutely. Well, from all of us over here at Alliance Wealth Advisors, we sure appreciate all of our clients who join us on this call every month. And until next month, thanks, everybody.